Today is March 3rd, 2026, and a coordinated multi-billion-dollar trap is actively being set in the darkest corners of the global commodities market. Their ultimate target is silver, and the mechanism of their attack has already been programmed into the algorithmic trading desks of the world's most powerful bullion banks. When the institutional short sellers finally pull the trigger on this engineered liquidity vacuum, the resulting artificial price collapse is specifically designed to entirely wipe out the unprepared, trigger a catastrophic wave of margin liquidations, and transfer millions of ounces of physical wealth from retail hands into institutional vaults. The screen price is going to plummet, the volatility will be violent, and you have been warned. Hello everyone, I am John AG, and welcome back to my channel. Do subscribe to my channel, Dark Macro, and also join my WhatsApp group for real, unfiltered market updates that you will not find anywhere else. It is a humble request for you. Please share this video with anyone holding hard assets, because YouTube simply does not push my videos to more people. The algorithms suppress this kind of raw, macroeconomic truth, and I need your help to break through the noise. Please watch this video till the very end to fully grasp the severity of the financial architecture we are up against. And if you want to help me continue delivering this high-level, institutional-grade research, please just hit the subscribe button. We are standing at the absolute precipice of a profound and irreversible recalibration in the global monetary system. As we navigate the escalating synchronized economic crises of 2026, the reality of our financial paradigm can no longer be hidden behind central bank rhetoric or manipulated inflation data. For decades, the global economy has operated on an unsustainable fiat currency model, fueled by the relentless expansion of sovereign debt and the artificial suppression of interest rates. We have watched global debt balloon to incomprehensible astronomical levels, crossing the point of mathematical no return. The central banks of the world, from the Federal Reserve to the European Central Bank to the Bank of Japan, are entirely trapped in a policy box of their own making. If they raise rates to defend their collapsing currencies, they detonate the largest sovereign debt and commercial real estate bubbles in recorded human history. If they pivot and monetize the debt by printing trillions of new currency units, they ignite a hyperinflationary firestorm that destroys the purchasing power of the middle class. There is no escape velocity from this debt spiral, and the masters of the global money system know it. In this chaotic, highly fragile macroeconomic environment, hard tangible assets have re-emerged as the ultimate and only mathematical refuge. But among all the physical assets available to the modern investor, silver has become the singular focal point of a historic silent war between retail preservation and institutional control. To understand why silver is the target of this impending crush, you must first divorce your mind from the idea that silver is merely a shiny rock or a secondary monetary metal. Silver is the most vital, indispensable, and strategically critical industrial element on the periodic table, second only to oil in its absolute necessity for modern human civilization. We are currently staring down the barrel of our sixth consecutive year of a severe structural supply deficit. The Silver Institute and global tracking agencies have documented a cumulative shortfall that is rapidly approaching 1 billion ounces. We are consuming vastly more silver than we are pulling out of the ground, and this dynamic is accelerating at a terrifying velocity. The demand side of the silver equation has gone completely parabolic, driven by inescapable geopolitical and technological megatrends. First, consider the massive global expansion of artificial intelligence. The build-out of AI data centers requires unprecedented amounts of electricity, and the specialized, high-performance computing components, switches, and conductive pathways rely heavily on silver's unmatched electrical and thermal conductivity. There is no substitute. Secondly, the global transition toward next-generation 5G and 6G telecommunications infrastructure demands millions of ounces of physical silver for base stations, antennas, and routing hardware. Furthermore, the relentless government-mandated push for green energy and electrification has placed an unbearable strain on the silver supply chain. Photovoltaic solar panels, which once used trace amounts of the metal, are now being manufactured by the billions, consuming massive percentages of the global silver supply. When you add the rapidly expanding electric vehicle market, where a single EV requires up to 3 times the silver of an internal combustion engine vehicle, the arithmetic becomes impossible to ignore. The physical market is tighter, more constrained, and more fundamentally broken than it has been in modern economic history. Yet mining output remains dangerously inelastic and completely unable to respond to this surging demand. You cannot simply flip a switch and mine more silver. The vast majority of the world's silver, over 70%, is pulled from the earth not from primary silver mines, but merely as a byproduct of zinc, copper, and lead mining operations. Therefore, even if the true price of silver were to double or triple overnight, it would not incentivize a massive flood of new supply, because base metal miners dictate their production schedules based on the demand for copper and zinc, not silver. Furthermore, the primary silver jurisdictions, particularly in Latin America, are facing rapidly declining ore grades, skyrocketing energy costs, relentless geopolitical instability, and resource nationalism. The physical metal is becoming undeniably scarce, and the institutions that manage the global paper markets know that their fractional reserve pricing scheme is mathematically living on borrowed time. Because of this undeniable physical reality, the elite institutions, bullion banks, and market makers are preparing a brutal, calculated, and highly coordinated takedown of the silver price. They will crush silver on a specific engineered date, and it is going to hurt anyone who does not understand the mechanics of the deception. This impending crash will not be driven by a sudden miraculous surplus of physical metal. It will not be driven by a drop in technological demand or an economic slowdown reducing industrial usage. Instead, it will be a deliberate, violent weaponization of the paper-to-physical ratio that dictates global commodity pricing on the COMEX and the LBMA. You must deeply understand how the pricing mechanism of your wealth is actually determined. The spot price of silver that you see flashing on your television screen or your trading app is not determined by the buying and selling of physical, tangible ounces of metal. It is dictated entirely by the hyper-financialized trading of unbacked derivative paper contracts. For every 1 ounce of physical silver sitting in a registered vault, there are hundreds of paper claims trading hands in the digital ether. It is a fractional reserve shell game of epic proportions, designed to absorb investment demand away from the physical metal and into a digital illusion of price exposure. When the bullion banks decide to paint the tape and break the price, they do not back up a truck and dump physical silver bars into the market. They execute what is known as a naked short. The mechanism of the impending crush is both brilliant and deeply nefarious. The institutional short sellers will wait for a highly specific window of low global liquidity, often the Sunday evening Globex Open, or a quiet holiday trading session when the volume is exceptionally thin. In a matter of milliseconds, their high-frequency trading algorithms will dump billions of dollars worth of unbacked synthetic paper contracts onto the futures market. This massive, instantaneous spoofing of the order book creates the immediate illusion of a massive supply glut. The algorithms read this sudden, violent influx of sell orders, and the price begins to cascade downward. But the initial drop is just the trigger. The real damage is done in the secondary phase of the attack. As the price falls through critical technical support levels, it triggers a cascading avalanche of automated stop-loss orders from retail traders and managed money hedge funds. This accelerates the downward momentum, creating a self-fulfilling prophecy of selling pressure. But the ultimate goal of the bullion banks is to trigger margin calls. When retail investors and leveraged speculators buy silver futures on margin, they are borrowing money to amplify their returns. When the paper price is violently forced down by the institutional shorts, these leveraged traders receive margin calls from their brokers, demanding that they deposit more cash immediately to cover their massive, sudden paper losses. Because most cannot cover these margin calls, their positions are force liquidated at the absolute bottom of the artificial crater. Their objective is sheer psychological warfare. It is designed to engineer a manufactured panic, to break the psychological resolve of the retail investor who thought they were protecting their wealth, and to force the liquidation of those leveraged positions. This orchestrated capitulation will create a violent, terrifying price crater, shaking loose the weak hands. The media will amplify the panic, running headlines about the collapse of the precious metals market, blinding the public to the fact that the underlying physical fundamentals have never been stronger. This is the desperate, thrashing symptom of a broken fiat paradigm, fighting to maintain its illusion of control over a system that is fundamentally tearing itself apart. Do not let the coming volatility blind you to the macroeconomic reality of what is truly occurring beneath the surface. The pain of the crush is temporary. The mathematical devaluation of fiat currency is permanent. For the astutely positioned macro investor, the individual who holds physical metal outside of the banking system, this engineered collapse is the ultimate misdirection. It is a final, desperate shakeout designed to transfer real physical wealth from a panicked, misinformed public directly into the vaults of the patient institutional elite. While the screen price plummets and retail investors panic sell their paper ETFs, the central banks of the East, the sovereign wealth funds, and the elite bullion banks themselves will be quietly backing up the truck, taking delivery of every physical ounce they can extract from the registered category of the exchanges. They are using the paper market to artificially suppress the price so they can accumulate the physical metal at a massive discount before the inevitable monetary reset occurs. We are witnessing a historic draining of Western vaults as gold and silver flow relentlessly from London and New York toward Shanghai, India, and the BRICS nations. These Eastern powers understand that the era of the debt-backed US dollar hegemony is fracturing. They are actively de-dollarizing their economies, dumping US treasuries, and stockpiling the only true, historically proven, uncounterfeitable money: physical gold and physical silver. When the East finally decides they have accumulated enough physical metal, they will simply break the paper pricing mechanism by demanding physical delivery en masse. When the COMEX experiences a true run on the physical vaults, and the hundreds of paper claims realize there is only one physical ounce to satisfy them, the force majeure clause will be invoked. The exchanges will settle in rapidly depreciating fiat cash, the physical market will completely detach from the paper illusion, and the true price of silver will be discovered in a chaotic, upward explosion that will leave the unprepared entirely destitute. This is why you must prepare your positions immediately, eliminate all leverage from your portfolio, and profoundly understand the fundamental difference between a temporary paper loss on a digital screen and holding a tangible, highly strategic asset during a sovereign debt crisis. The greatest wealth transfer in the history of human civilization is currently underway. The system is not broken. It is functioning exactly as it was designed, to funnel real wealth upward during times of engineered crisis. History will not be kind to those who mistake a manipulated screen price for true, intrinsic value. You must become your own central bank, secure your physical assets, and see through the matrix of paper manipulation. Thank you for your time, your intense focus, and your unwavering commitment to discovering the truth of our global money systems. Stay vigilant, stay thoroughly prepared, and remember to subscribe to Dark Macro.